how you actually perceive a moving average. And let me give you a clue. It's you have to perceive it differently than what the masses do. Step number 1 says you want to start seeing the moving average line as a representation of the changing tides of overall sentiment rather than an exact price guide. Now, here's what I mean by that. Most traders use moving averages for exact risk levels, which will constantly cause them to be stopped out. Like we saw in the example earlier, when you get in those tight sideways markets, there's a lot of crossovers that end up being false and you could get stopped out. You want to use the moving average to understand what they're thinking and how prices will potentially be manipulated at the crossover points. So when it's crossing over, you want to understand, how are the institutions going to use this to create liquidity? How are the smarter, bigger players going to use this visual crossover to their advantage? You'll notice there's a lot of clean, easy crossovers like we have highlighted here, where traders will see that and they'll want to sell the market. But you'll notice if you backtest and you look back at any moving average setting, you'll see a lot of this. You'll see price manipulation happens right after that. Those traders that originally traded the crossover end up getting stopped out. And that's because that's a strong point that the market could be manipulated by the smarter players. Same thing down here. We have a clean, easy crossover. Feels like an easy buying opportunity, actually puts you into the money, but then followed by price manipulation, stopping those traders out. And you'll notice in both of these circumstances, both of when the traders sold and when they bought on both these crossovers, the market actually eventually did what they thought it was going to do. But if you don't understand that these can be potential manipulation points and you don't understand the master pattern that's happening behind the scenes, then this could be a very frustrating situation to deal with. So in a nutshell, step number 1 is for you to start looking at those moving averages as an insight into what other less informed traders might be thinking and see how price acts around those crossover points. Step number 2 is to calibrate your moving average line to represent the price flow average of a higher time frame chart. So this is going to serve as your filter and directional bias. Let me show you what I mean by this. In this example, I have 2 charts side by side. USD CAD is what we took the data from. You'll see on the left side, we have the daily chart. On the right side, we have a 1-hour chart. So what was I talking about when I say calibrate your moving average to represent the higher time frame? Well, this is what I mean. You want to use a moving average line to represent the average price flow of 2 daily candles or 2 candles of whatever your higher time frame chart is. In this example, I have the 1 hour into the daily. So, but you want to calibrate it to represent the average price flow of 2 of those higher time frame candles. In this case, we have the daily. So, how many 1-hour candles are in one day? Pretty simple answer. There's 24 hours in a day, so there would be 24 1-hour candles. We would times that by 2. So we have an average of 2 days, 2 daily candles, which would be 48. So you should use a 48 period moving average when trading the 1-hour chart into the daily. Step number 3, you want to plot out the last daily value line. And I'll say in our case, we're using the daily chart in our example, but this would be whatever your higher time frame chart is. You want to plot out the last value line and then wait until your higher time frame is clearly in the trending phase or at least in a big enough expansion phase to justify enough upside opportunity. Let me show you what I mean by that. In this example right here, we have our daily chart. It's settling under value, which shows that the higher time frame players are likely preparing to move the market to lower prices. So we've seen the contraction. We've seen the expansion, that first and second expansion leg. Now we're seeing that price settling, which clues us into prices are probably going to now move downward. So we're in preparation for that move. Okay, so now that we've done our homework on the higher time frame, step number 4 is to now start tracking value on your lower time frame. Let's go back to the example. Again, we clearly see that the daily has settled below value. It's starting to move down. We can start tracking value on the lower time frame. In this case, we have the 1-hour chart. You want to find the most predominant contraction points as they develop. And then you want to draw boxes over those contraction points to define value on the lower time frame. Step number 5. Now we want to use the value lines on our lower time frame to define discounted or strong entry points in trend with the higher time frame. You'll notice that we have the 2 value points marked up, but what was the price action in and around those value points? Let's talk about that. All prices above value will be considered inefficiently priced, and this is key, in a true downtrend. If your higher time frame is truly in a downtrend, which you should be able to decipher based off of what phase it's in, then all prices above value on the lower time frame will be considered inefficiently priced, and they should equate to strong entry points for you to take advantage of. So you want to sell the market above value in a downtrend. Obviously, this would be the opposite in an uptrend. And then after you do this, where does the moving average come in? You want to use the moving average line to make sure the wave of market activity remains in your favor. So rather than getting suckered into those false crossovers and every little crossover that can happen with the moving average, you start to see that moving average is just a wave of sentiment, but you're fine-tuning your entry points based off of the master pattern, based off of understanding the true market value that you're dealing with in that price range. So that pretty much covers the basics of how to identify the setup for the strategy. Now let's cover the rules, because no strategy is complete without some really hard to execute rules. Just kidding. So the first rule is to not set rigid rules. What do I mean by this? You don't want to set hard stop loss and take profit rules, because if you always have a 10 pip stop and a 10 pip limit, or 20 pip stop and a 20 pip limit, and you say this is what's always going to work, remember the market cycles are going to change and those stop loss levels are going to have to adapt with the market, which brings me to the next point. You want to be flexible and adjust your position size and your risk allowance according to the market framework that you are given to work within. Remember, when you're dealing with market framework, you're dealing with the contraction points that the market presents. This is something the market defines and not us. So we want to be flexible enough to adapt our position sizing and our risk tolerance to the market framework and not what we want it to be alone. Third point, don't trade until you feel confident about the future direction of your higher time frame. This is a huge mistake people make when trading this general strategy, is that they feel like I'm a trader, I need to be in a trade. They just look at the lower time frame and they say, that looks enough like a trade I'm in. You want to wait until you feel great about the higher time frame. You understand what cycle it's in. You understand the sensitive points. You understand where the trend is likely gonna take place to higher or lower prices. When you feel great about that higher time frame, that's when you start looking at the lower time frame for your actual entry point. And the last thing is you really want to be careful trading around big news releases. This goes for any strategy that you're using to approach the market. Whenever you have a lot of liquidity that can